All right, let's jump right into your January 2026 tax update. There are some really major changes on the horizon that are going to affect just about everyone, whether you're a freelancer, a landlord, or work for a big company. So let's get you prepared. So I've got to ask you straight up. Are you ready for this? Because honestly, the way you deal with the tax system is about to get a pretty big overhaul. Let's make sure you're ahead of the game. First up, let's talk about the big one. Making tax digital, or MTD as you'll hear it called. If you're self-employed or a landlord, this is, without a doubt, the most significant shift in how you report your taxes that we've seen in a generation. So what is this thing? Well, it's a huge change from the old way of doing one single tax return at the end of the year. With MTD, you're going to be keeping digital records and sending updates to HMRC 4 times a year. Yeah, quarterly. The whole idea is to get a much more accurate real-time picture of what's going on. Now, I know what you're thinking. Quarterly deadlines sound like a nightmare, right? Well, before you panic, there's some good news. For that very first year, that's the 2026 to 2027 tax year, HMRC is giving everyone a bit of a break. There will be no late filing penalties for those quarterly updates, which gives everybody some breathing room to get used to the new system, kind of like a soft landing. Let's put this on a calendar so you can see how it all plays out. For most self-employed folks and landlords, the starting gun fires in April 2026. Then there's a smaller, specific group that gets an extra year, and their journey starts in April 2027. And just remember, on top of those quarterly updates, you still have to file a final annual return, and the very first one will be due by January 2028. So you might be wondering, hey, do I get that extra year? Well, let's take a look. That delay until April 2027 is for a few very specific groups. We're talking about people with income from trusts and also farmers and artists who use a thing called income averaging. Have a quick scan of the list. If you fall into one of these categories, you've got a little more time to get ready. Okay, that covers the self-employed for now. But what if you're an employee? Well, your paycheck is in for a couple of big changes too, and these will definitely have an impact. This one is a really big deal for anyone who's been working from home. You know that flat rate tax deduction of £6 a week? Well, from April 2026, it's gone. It's being abolished. The new rule is much, much stricter. Now your employer can only pay you back tax-free if working from home is a formal, written requirement in your contract, not just something you do flexibly. That's a much higher bar to clear. And the next change coming down the pipeline for employees kicks in April 2027. We're talking about benefits in kind, things like a company car or private medical insurance. From then on, the tax on these benefits is going to be handled through your monthly payroll. It's becoming mandatory. Communication here is going to be absolutely crucial. Instead of dealing with the tax on benefits at the end of the year, it'll happen in real time, every month. Now, pay close attention to this third point, because this is where it can get confusing. During the switchover, it might feel like you're being taxed twice. That's because you'll be paying the new, real-time tax while your tax code is also settling up the bill from the year before. It's just a temporary catch-up phase, but it's important to know it's coming. Okay, let's shift gears and look a little further into the future now, especially for all you businesses out there. There's a huge technological revolution on the way that's going to completely change how you do invoicing. Okay, so what on earth is e-invoicing? And listen, this part is super important. We are not just talking about emailing a PDF of an invoice. That's not it. This is about the structured digital exchange of invoice data straight from your supplier's accounting software directly into yours. It's about machines talking to machines. And don't think this is some far-off sci-fi concept. There's a real roadmap for this. By 2029, e-invoicing is set to become mandatory for most VAT invoices. And you can probably guess the next step, right? After that, it'll be real-time reporting of all that data directly to HMRC. This really is the future of business transactions. All this talk about digital systems and future tech can feel a bit abstract. So, to bring us back down to earth, I've got a fantastic story for you that shows just how wild and complicated today's tax laws can be. And believe it or not, it's all about a hot chicken. Yeah, you heard that right. A rotisserie chicken in tax court. It sounds like the beginning of a bad joke, doesn't it? But a supermarket's chicken really did become the center of a massive legal fight with HMRC. Let's find out why. Because the stakes were, well, they were huge. We're not talking about a small disagreement here. The VAT bill that the supermarket was fighting was over £17 million. That is a lot of chicken.
So this entire massive multi-million-pound case came down to one simple, almost silly question. Was the chicken hot or was it cold? See, in the UK, most food has zero VAT, but if it's hot takeaway food, it gets hit with the standard 20% rate. So HMRC said the chickens were hot, and the supermarket said, no way, they're cold.
And the whole thing hinged on the evidence, which, crazily enough, all came down to the packaging. The court looked at the science. An unwrapped chicken lost its heat way faster than one that was put in the store's special plastic-lined bag. The finding? That packaging was specifically designed to keep the chicken warm.
And there you have it. That was the smoking gun, or maybe the warming bag. The court ruled that because the packaging kept the chicken warm, it officially counted as hot takeaway food. And just like that, those chickens were subject to 20% VAT. A tiny detail with a 17 million pound price tag.
All right, that was a fun little detour into the weird world of VAT. Let's wrap things up with some practical numbers and dates you'll want to keep handy for the next few months. First up, for those of you with a company car, here are the latest advisory fuel rates from back in December for claiming business mileage. You can see how the rates change depending on your engine size for petrol and diesel. And hey, don't forget the separate rates for electric cars. 7p a mile if you charge at home, 14p if you use a public charger. And what if you're using your own car for work? Just a quick reminder that the tax-free mileage rate, that's the AMAP rate, it hasn't changed. It's still 45 pence a mile for the first 10,000 miles. And finally, let's talk deadlines, because you do not want to miss these. You've got your regular monthly dates for employers to submit PAE and national insurance, but the big one, the one to circle on your calendar in bright red ink, is January 31st. That's your deadline for getting your online self-assessment sorted for the 24-25 tax year and for paying any tax you owe. Please don't let that one sneak up on you. So what's the big takeaway here? Look, tax law is always going to be complex. I mean, we just talked about the temperature of a chicken deciding a multi-million-pound case. But staying on top of the big changes that actually affect you, that can be simple. Hopefully this breakdown leaves you feeling a bit more ready for what's coming down the road.